Day trading is something that attracts most beginners into trading in the first place. Since traders get huge leverage on day trading, it becomes very easy to make profits off small moves during the day. While profits can be huge, losses can also be unmanageable in day trading. In this video, I will be sharing some of my secret tactics and techniques that can help you determine the direction and sentiments of the market for the current day. The concepts shared in this video are not something that I have created or invented on my own. I have learned these concepts through my study of the market profile indicator. Even if you don't use the market profile indicator, the concepts remain usable for all traders. Before we start, be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. The time frame generally depends on the trader. But for the sake of this video, we will use the 5-minute time frame. Now let's talk about the strategy itself. In this strategy, we will not use any indicators. We will only use the previous day range to make trade decisions. The range of the previous day is something very important in day trading. It provides us with a boundary for the price action of the current day. Think logically. The prior day range shows us an area of price where the buyers and sellers exchanged the asset. So we can say that the buyers and sellers saw this price area as a fair value of the asset on that day. If they did not see this price as fair value, then they would not have exchanged the asset. Therefore, the previous day's range shows us the area where buyers and sellers saw fair value. You can automatically plot the previous day range by the use of a simple indicator. Simply search previous day high-low in the indicator section of your trading software, and most probably you will find an indicator for that. If you can't find an indicator, you can manually plot the previous day high-low on the charts. Once you plot the high and lows of the previous day, you are ready to trade. In this strategy, we aim to identify the market sentiments by looking at the current day's opening price compared to the prior range. Now let's understand different scenarios involving the prior day range. There are 3 scenarios that can happen on the open for the current day. Scenario number 1. The price opens and stays within the previous day's range. If the price opens and stays within the previous day's range for the first 5-minute candle, we can conclude that the sentiments have not changed overnight. If the buyers were optimistic, the price should have opened above the prior range. Similarly, if the sellers were strong, the price would have opened below the prior day range. But the traders saw the prior range as a fair value of the price and therefore, they kept the price within the range. So the price is expected to stay within the previous day's range for the rest of the day. The highs and the lows of the previous day will act as a level of support and resistance on such a day. Breakout failures of previous day highs and lows are a good trading strategy for such a day. On such days, the price generally is in a sideways range, and we do not see a lot of movement in price. But this does not mean that the price will not break outside of the previous day range. Most of the time the price will remain intact, but in some instances, we can see a late breakout of the previous day range during the last hours of the day. Again, the best trades for such days will be to sell near the prior day high and buy near the prior day low. Scenario number 2. The price opens within the prior range, but immediately breaks out of the range. Sometimes, you will notice that the price opens within the prior day's range, but it will immediately break above or below the day range and close outside. This shows that the buyers and sellers don't see the current price as fair value, and one of them is pushing the price very hard. For instance, on this chart, we can see that the price opened within the previous day's range, but it immediately moved upwards and closed the first 5-minute candle above the previous day high. This is a strong signal that the buyers have become optimistic overnight, and there is a bullish sentiment in the price today. On such days, you will generally see the price trend in one direction for the entire day. So, if such a day develops, you can enter at the first candle itself and ride the trend until the end of the day. Scenario number 3. The price opens beyond the previous day range. When the price opens beyond the prior day's range, this shows that the traders no longer see the prior range as fair value. Therefore, the price can move in any direction in the search of value. The best thing to do in such cases is to not trade on such days. The reason is pretty simple. The price has opened at an extended price. We do not know how the market participants will react to the new price. So the price can go in any direction. I personally avoid trading on such days, and I recommend you to do so as well. On some occasions, you will see that the price opens slightly outside the range of the previous day, but it is unable to sustain there. Within the first 4 to 5 candles, the price will come inside the previous day range. In such cases, you can trade the break inside the previous day range. So these were 3 scenarios where you can detect the sentiments of the markets using the open of the price in relation to the previous day range. Now let's look at some trade examples to understand how to trade in these scenarios. Look at this chart. First, we see that the price opened within the range of the previous day. Within the first 4 to 5 candles, we see that the price sustains itself within the previous day range. There was no break above or below the prior range. So this is a strong sign that the sentiments of the traders have not changed, and therefore, the price is expected to sustain within the previous day's range. Here at this point, we see that the price breaks below the previous day's low. But we know that the price is expected to be in a range. Therefore, we expect the price to find support near the previous day low. So we will not sell at this breakout. As I said earlier, on such days, breakouts can happen late in the day. If this particular breakout would have happened late in the day, then we might have considered it as a strong breakout. But because it happened early during the day, it has a high probability of failure. And as you can see, the breakout failed. When the price again crosses the previous day low from below, we can buy at this candle. So we will initiate a buy trade as we expect the price to bounce upwards from the previous day low. We can keep our stop loss below the candle, and we can target 1:1.5 risk-reward ratio. And as you can see, the price made a strong up move after our entry. Let's look at another example. On this chart, we see that the price opened within the range of the previous day, but the candle actually closed below the previous day low. In other words, the price broke out of the previous day range. This is a strong sign that the sellers are in the mood of pushing the prices downwards. So we expect a strong downtrend. The breakout of the prior range is a strong sell signal. Therefore, we will place a sell trade at this candle. We can keep our stop loss above the prior day low. On such days, the price will generally continue the down move throughout the day. So we should target more than usual. I like to exit half my position at 1:1.5 risk-reward ratio, and I exit the remaining position at the very end of the day. And as you can see, the price stayed in a downtrend throughout the day. A breakout of the prior day range on the first candle can be a very powerful tool in predicting huge trends. So keep an eye on these setups. In fact, this particular setup can be your bread and butter setup. Here is another trade. On this day, we noticed that the price opened outside the prior day range, and it plotted a few candles there. Generally, we would avoid trading on such a day. We would only consider trading if it returns to the prior day range. On this particular day, the price was unable to sustain above the range, and it eventually fell below the prior day high. This was a great opportunity for us to sell. So we place a sell trade below the low of this candle, and we can keep our stop loss above the entry candle. We can target the normal 1:1.5 risk-reward ratio. And as you can see, we made profits on this trade. That brings us to the end of this video. I suggest you to watch this video at least 2 to 3 times to completely understand the concepts that are taught here. With this video, I have tried to show you how to use simple logical to trade with high probability. The relationship between the open and the prior range is very powerful, and once you understand that, you will automatically develop the skill to identify the sentiment